It is the iron law of nature that you get what you deserve. Let's say you could buy a business just by chatting with the person running it for 30 minutes. No financial reports, no technical charts, no market data. What would you ask, and more importantly, what will you believe to make your decision? In an age where investing is misconstrued as an art of faster clicks and smarter algorithms than this book. Chairman Lead Investor does not offer a way to get rich. It does something more dangerous, requiring you to stop and think. And that's why it's inconvenient, addictive, and not for those looking for a sense of security. Munger does not offer advice. He throws out paradoxes. He did not copy the rules. He questions fundamental beliefs, and in an investment world filled with noise and prejudice, it is this unsettling clarity that makes his thinking as urgent as a flashlight in a room full of distorted mirrors. This book doesn't require you to agree or disagree, but if you're brave enough to be challenged and humble enough to look at yourself, you may find that you look at investing and your decision-making differently than you did before. We encourage listeners to buy and read this book to fully appreciate its content. Now let's get started. Summary of this book. Chapter 1. The Basics of Graham's Value Investing System. I never believed that investing was an art reserved for geniuses. I believe it is a survival skill, like how one learns to survive in the jungle. Not by innate intelligence, but by understanding where you stand, what you are facing, and when to retreat. That's why I followed Benjamin Graham's path. Not only did he teach me how to read a balance sheet, he also taught me something more important. When the market goes crazy, the one who stands still wins. I started my journey into the investing world with simple questions. Why do people invest? How not to lose money? What makes a good decision? And then it was as if the universe arranged it. I encountered Graham's philosophy. That philosophy was unlike anything I had seen on Wall Street, where people are like educated gamblers. Graham made me stop. Investing, he said, is when you do careful analysis, can ensure the safety of your capital, and expect a reasonable return if all three are not met. That's not investing, that's speculation. It sounds simple, but to live by that philosophy in the midst of a chaotic market, you have to have what I call an iron mind. Something few people have and no one teaches you in school. Graham was like a strict but sincere father. He didn't sugarcoat the dream of getting rich. He forced you to look straight at the nature. He taught me that the intrinsic value of a company is not something reflected on an electronic board. It is a number that can be estimated based on the future cash flows that the business can generate, discounted back to the present at a reasonable interest rate. If the market price is significantly lower than that intrinsic value, you have an opportunity. If not, turn around. I once asked, what if I don't understand the company? Graham smiled. Putting it in the basket is too difficult. You have to invest in everything. You just wait for the opportunity to be as clear as a sledgehammer in the right place and swing the bat when it comes. That's what I learned from Warren Buffett, whom I was fortunate to work with. He had a bucket with 3 labels, S, NO, and TOT. Most of the opportunities fall into NO or TOT. Only a few fall into TOT, but they are often great opportunities. Our philosophy is not to invest often, just invest at the right time. I've seen many new investors entering the profession like entering a casino. They get caught up in the rhythm, the cheers, the charts. They forget the most important thing. Behind every stock is a real business with real people, real machines, and real money flowing in or out. One of Graham's life principles is the margin of safety. Imagine you are building a bridge. If the maximum load is 10 tons, you build to support 30 tons, not because you are scared, but because you are smart. The same is true in investing. Buy when the price is below the intrinsic value by a large enough margin so that when you are wrong a little, you can still survive. I have seen too many people die because they have no margin of safety. They buy stocks because of news, because of rumors, because of technical analysis that smells of reason but is actually empty. They walk as if they can never fall, and when they fall, they cannot get up again. I do not deny the importance of analytical skills, but if I had to choose between a person who understands finance very well but is easily influenced by emotions and a person who analyzes at a mediocre level but is disciplined, I would bet on the second one. Because the market is where emotions are exaggerated, greed, fear, excitement, despair. All happen hourly, minutely. The survivor is not the one who sees the best opportunities but the one who refuses 99% of the unnecessary. So, I always start by asking, is this company easy to understand? Does it have a clear business model? Does it have a sustainable competitive advantage? Does it have credible leadership? Is it reliable? I don't need it to grow like a rocket. I just need it to be a slow, steady, money-printing machine that can't be easily replaced. Someone asked me, don't you think I'm a little too conservative? I just laughed. I didn't come to the market to be an innovator. I came to survive and accumulate. Real wealth doesn't come from reckless bets, it comes from not making serious mistakes over 30 years of investing effectively. You have to be willing to wait, and waiting is not a passive state. It's a very proactive, very difficult form of action. I sat idle for years, not touching any new investments. It's not because I don't have money, it's because I haven't found a worthy opportunity. People often think of investing as a never-ending series of actions. They see cash and think it's a waste to leave it alone. But I am different. I think like a shooter. If the target is not clear, I don't pull the trigger. I'd rather be criticized for being slow than face the consequences of a hasty decision. Another important part of my philosophy is learning to think counterintuitive. If the majority of people are doing something, I immediately become suspicious. Not because I'm against it, but because I know herd mentality often leads to disaster. People buy when prices rise and sell when prices fall. I do the opposite. I buy when there is blood in the streets and sell when people are partying on the trading floor. I was once asked, how do you know when the bottom is? I replied, I don't need to know. I just need to know when the price is too low and then I buy. I don't need to catch the bottom, I just need a big enough gap between price and value so that the error doesn't kill me. In the early years, I was caught up in calculating every index, every cash flow, every rate. But as time went on, I simplified things. I learned to look at the bigger picture. Is this a business that is easy to understand, honest, has potential and is being mispriced by the market? If the answer is yes, I don't need more data. I like businesses like Coca-Cola, Costco, where everything is as clear as noonday light. You don't need to be a financial expert to see how well they are operating. These types of businesses have a big advantage. They are less dependent on genius management because their systems are strong, stable and hard to copy. In the investment world, people are often engrossed in searching for alpha, the profit outperforming the market. I look for negative beta, which means not dying when the market goes crazy. Survival is already a victory. Because if you keep your capital over many cycles, the profits will come by themselves. Compound interest requires two things, one is time, two is not losing capital. Good investment decisions never come from a state of mental disorder. When you are angry, excited, panicked or competitive, that is when you are most likely to make mistakes. So I often let a decision sleep overnight. If the next morning it still seems reasonable, I act. I have missed many opportunities because of that caution. But I have never regretted missing as part of the game. You don't have to hit every shot. You just have to avoid the fatal mistakes. People lose because of serious mistakes. Not because of lack of opportunities. That is why I don't follow trends. When the real estate boom, I stay out. When the real estate fever is on, I stay out. I am called old-fashioned, backward. But I don't care. I don't invest for approval. I invest for freedom. Freedom from the fear of losing money. Freedom from being a slave to the market. Is there a secret to success? I don't believe in secrets, I believe in discipline. I believe in self-limiting knowledge. And I believe in doing the right thing over and over again. I also never forget that I might be wrong. It's part of my survival strategy. I always assume I'm wrong and only act when the margin of error allows me to survive. This is not a lack of confidence. This is a strategy for protecting myself in an uncertain world. Graham once said, in the short run, the market is a voting machine, in the long run, it is a weighing machine. I live by that saying. I am not looking for consensus. I look for the real weight of a business. And I'm willing to wait until the market sees that too. There is another way, a way without noise, without luck, without risk. You just have to have enough patience, reason and humility to accept that you don't have to do everything, just do a few things right, really right. And that's how I've lived, invested, and navigated 4 decades without getting eaten up by the market. Chapter 2. Principles of Graham's Value Investing System. I used to think that investing only required a few mathematical formulas and financial reports. But then I realized, like any long-term game, investing is not just a skill, it is a philosophy of life, something that requires you to have principles. And without principles, you will always be at the mercy of the market. Like a hunting dog running at the whistle, never knowing where it is going. Graham offered principles as a guide to navigating the turbulent world of investing. With me. Each of those principles is like an arrow on a compass. Keep me from getting lost in the chaos of Go Street. The first principle is to distinguish between investment and speculation. It sounds simple, but try asking 10 people who are buying stocks in the market. Perhaps 7 people don't really know if they are investing or just betting that prices will go up. Graham said, if you're not sure you're reinvesting, you're probably speculating. I like that gentle irony. It's startling. I've seen speculators make a killing for a season. They show off their strategies, share tips, and teach how to get rich. But then, just one market turn, and it all disappears like soap bubbles. Investing isn't really that exciting. It's slow, boring, and sometimes makes you doubt yourself. But it's sustainable. It's the kind of sustainability that's like the northern redwoods, standing still in the snow. The second principle, protect capital first. Profit comes second. This principle has saved me from dozens of bad decisions. I don't look for the biggest profit. I look for the most risk-reducing way. You can call it the mindset of a weak-minded person. I call it the mindset of someone who understands what kills investors the fastest. You can make 100% profit one year. But if the next year you lose 50%, you get nowhere. I learned to put myself in the worst-case scenario before I put pen to paper. I always asked myself, if things didn't go as I thought, would I survive? If the answer was no, I backed away even if the opportunity seemed appealing. Graham's third rule is to demand a margin of safety. I've said it before, but I'll say it again because it all starts here. The market doesn't forgive mistakes, and since you're human, you're going to make mistakes. A margin of safety is the only buffer between you and a crash if the stock price is 30 to 40% below your calculated true value. And if you've done your calculations carefully, that's probably an opportunity. If it's only 5% below, I call it a gamble. The fourth rule is the market is your crazy neighbor. This is one of my favorite images from Graham. He said, imagine you have a neighbor named Met. Every day he comes knocking on your door, offering to buy or sell your company shares at prices that change constantly, sometimes too high, sometimes too low, without any rules, and you have the right to buy, sell, or ignore. The wonderful thing is that you don't have to react to him every day. You just have to wait until he goes crazy in a way that benefits you. The mayor is like that, you don't have to be good at predicting it. You just have to be good at controlling yourself against it. The fifth principle, value investing, is investing in businesses, not stocks. This sounds easy, but very few people really understand it. They see the stock ticker, they see the price, they see the chart, but they don't see the company behind it. I asked a new investor, "What are you investing in?" He replied, "The baby code has a very strong brake pattern." I shook my head. I'm not asking about the model, I'm asking about the business. Graham taught me to look beyond the charts, beyond the reports, to see a real company with real products, real cash flow, real people. Only when you understand a company as well as you understand yourself should you put money into it. The final principle in Graham's system is discipline. There is no substitute for discipline. Not intelligence, not network, not speed of response to news. It all means nothing if you don't have the ability to do the right thing consistently over time. I'm not saying I'm perfect. I've made mistakes, I've been tempted, I've been persuaded by promises of huge profits. But what keeps me coming back to these principles every time? They are like roadside stakes. On a foggy night. I don't always see the end, but I always know I'm not falling off the cliff. Those principles were all theory until the market actually punched me in the face. It was in the early 80s when an investment I pursued with complete logic, full of data, suddenly plummeted just because of a tax policy change from the government. The real value was still there. The business is still doing well, but the stock price is falling like a rock. I sat there watching my investment fall in value every day and wondered if I was wrong or if this was the time when the market was crazy like the mare market that day. I didn't sell because I understood the principles, and many years later that investment brought in more profit than anything I had ever held before. That lesson didn't come from the classroom but from the scratches the market left. That's when I really understood that principles are not just theory. They are the blueprint for you to build a mindset, an inner strength without which you can easily be swept away by rumors, news, and speculative waves. And the worst part is you don't even know you're being sucked in. Graham never taught me how to predict the market. He taught me how to respond to it with steadfastness. When everyone around you is panicking, can you keep your cool? When others are greedy, can you stand still? And when others stand still, do you dare to step forward? That's where the principle comes into play, not to win every game but to never be caught out by someone else's game. I call it disciplined independent thinking. Independent thinking helps you see the world through your own eyes. Discipline keeps you from betraying that look when everyone else is looking the other way. There is an image that I really like when it comes to principled investing. That is the image of the farmer. You can't make a rice plant grow faster by shouting at it. You also can't fertilize every day in hopes of speeding up the cycle. You need to plant in the dry season, care for it in the rainy season, and then harvest when the weather is favorable. Any haste leads to crop failure. Investing is the same. Sometimes you have to wait, sometimes you have to stand still, sometimes you have to cut your losses, and sometimes you have to admit you are wrong. But don't give up on principles, because principles are the only thing that keeps you from becoming a speculator disguised as an investor. Do principles ever go out of style? I say only when human greed becomes obsolete, which I have never seen happen. Greed is still there like a shadow behind every price increase. Fear is still there as an echo beneath every crisis. And when greed and fear remain, principle remains your only shield. It sounds like a monk in the middle of Go Street, and it's not wrong. Principled investing is a journey that requires mindfulness like meditation. Not because it requires you to detach yourself from life, but because you must learn not to let life control you. You must learn to say no to easy opportunities, say no to rumors, say no to promises of getting rich quick. It's those no's that open the doors to your greatest opportunities. Because when you have principles, you become rare, and in the investment world what is rare? That is valuable. When I look back on my 30 years of investing, it's not the biggest trades that I'm proud of, it's the times I did nothing, the times I kept cash in my pocket while the market was having a party. There were times I turned down a great opportunity because it was beyond my understanding. It was then that I realized that principles are what set you free. Without principles, you are a prisoner of yourself. Investing is not a game of who is faster, who knows more, or who is more reckless. It's a game of who knows themselves better, who waits better, and who stays true to their principles longer. You can be wrong many times. But if you are always wrong within the framework of principles, you still have a way to live. But if you are right a few times by luck but have no principles, sooner or later you will be wrong. The market will also take back what it gave you. That's all I learned from Graham. Not just to invest better, but to live more slowly, more clearly, and more sustainably in a world that is always trying to push you faster than you can. Chapter 3, Universal Wisdom. I used to think knowledge came from books. Then I realized the world doesn't work the way the textbooks teach. It operates by means of intersecting systems, nested principles, and hidden laws beneath the surface. But if you only look through a single lens, you will always miss the most important thing. And that's when I started building myself a universal intelligence system. I call it the multidisciplinary thinking model. But don't let that complicated name put you off. Its essence is very simple. I borrow basic principles from many different fields. Psychology, physics, biology, mathematics, economics, law, and string them together like pearls to illuminate investment decisions. Because I believe that truth is not just in the accounting books, it is in how people behave, how the world works, and how beliefs are formed and broken. Graham taught me the foundation of investing. But to grow beyond my limits, I had to step into a wider world. I studied physics to understand system feedback, and psychology to recognize cognitive biases. Students learn to see natural selection in businesses. And I study history not to memorize dates but to see that greed and fear are two machines that never stop working in human society. When I said that in the street, people laughed. They think I'm some old geek musing about dinosaur extinction while the market is rallying. But then they started coming to me when the market crashed. Because at that point pricing formulas can no longer save them. They need a broader cognitive system. To understand what's really going on, let's take an example. You see a company that is growing well, revenue is exceeding expectations, market share is expanding, everything is beautiful. But if you don't understand regression to the mean, a simple concept in statistics, it's easy to believe that the rally will last forever and you invest as if tomorrow will be as bright as today. When the company starts to falter, you are surprised, panic and sell. But if you have regression to the mean in mind, you know that nothing goes up forever. You will be prepared before the market. Universal intelligence allows me to look at a company the way a doctor looks at a patient, not just looking at test results but looking at the whole person, lifestyle, genetics, response to the environment. It helps me spot abnormalities before they become problems. For example, a company with an overheated growth rate, like a person who drinks too much caffeine, will sooner or later run into complications. I believe that investors cannot just be financial experts, they must be thinkers. If you are not curious enough to step out of your field, you will always be stuck in thinking traps. Thinking that every problem can be solved with an Excel formula. In reality, many of the biggest mistakes in investing come from things that Excel can't measure, like human motivation, cultural change, or social network effects. I studied psychology not to manipulate others but to protect myself from the illusions in my own brain. I discovered that we are not as rational as we think. We are biased because of confirmation bias. We are more obsessed with losses than rewards. We cling to the familiar and we judge the future based on our present feelings. If you don't recognize these, you will be a victim of them in every investment decision. I also studied law to understand power structures sometimes. The reason a company does well is not because of its products but because of its ownership structure and legal position. Understanding the rules helps me see who really controls the game and who is just a pawn. That's what financial statements never tell you. I studied biology to understand natural selection. I see the market as nothing more than an ecosystem. Weak companies will be eliminated. Companies that adapt well will survive, and sometimes a small mutation, a new technology, a change in customer behavior can lead to mass extinction, just like how dinosaurs disappeared not because they were weak but because they could not adapt to the climate. And I study history so as not to be surprised by its repetition. People think every crisis is new, but if you read enough, you will see old mistakes just dressed up in new clothes. The Dutch tulip bubble. Calm mania, the collapse of Lehman Brothers. They are all manifestations of one thing. People always think this time is different. I walked into an investment meeting where people were talking about a hot tech stock. Everyone agreed that the company was the future of the industry. That the business model cannot be replaced, that whoever doesn't get in now will miss the boat. I sat quietly watching, not because I didn't understand, but because I heard these words too many times, from Aon to PCOM, to dozens of other names that were once praised and then disappeared from the financial map. I said nothing because sometimes wisdom lies not in what you say but in not getting caught up in the fever. Conventional wisdom does not help you predict every market move accurately. It keeps you from being destroyed by things that others don't see. It's like you have an extra radar. When the market is calm, you can still hear thunder in the distance. Not to panic, but to prepare. I believe in people with perceptive eyesight, which sees through the surface of the profession. Such people can not only analyze financial reports but also sense crowd psychology, understand the impact of a legal decision, and predict the rhythm of consumer culture. They are like musicians who play many instruments, not to show off their talent, but to know when to play what and when to keep quiet. What is the real competitive advantage in modern investing? I wouldn't say information, I wouldn't say transaction speed, I would say integration. People who can integrate multiple mental models from different fields. Is someone who can see what others miss. And when you see what others don't see, you have the opportunity to do what others see-an't. Someone said to me, "But I don't have time to learn as many things as you do." I replied, "You don't need to learn deeply, just enough to have the right mental model. You don't need to be a physicist to understand chain reactions, you don't need to be a psychologist to recognize cognitive biases. Just enough to ask a good question, enough to be skeptical of what is presented on the surface." That's what I do every day. I read widely, not to become a scholar, but to become a survivor. I read about war to understand strategy, read about biology to understand competition, read about mythology to understand human behavior. Read about probability to understand risk. For me, each field is a flashlight and I need all of them to shine on the investment picture I am looking at. The world is not separate. A good investment decision does not come from an excellent analysis but from a series of observations across disciplines, across time, across perspectives. Investing is not about precise math. It is a game of ifs and maybes. And universal wisdom helps you live in the fog blind. You may think I'm idealistic, that investing is about money, not philosophy. But I believe the opposite. Because investing is about money, what feeds you, determines your freedom, it needs more philosophy than any other field. If you enter the market with only the goal of getting rich, you will quickly be caught up in the blind race. Only when you enter with a solid value system and a solid system of thinking, will you be able to weather the storms without being defeated. If you ask me where I should start, I would say start with the things that others don't bother to learn. Behavioral psychology, the history of financial bubbles, evolutionary biology, competition law, and even skeptical philosophy. You don't need to be an expert in all of them, but be someone who sees the connections and always ask, what mental model is at work here that I haven't seen? Graham gave me the principles, but it was universal wisdom that gave me the eyes to see far. Then the books. I'm not a fortune teller, I'm just someone who tries to see the big picture enough so that when opportunities come or when dangers arise, I'm not caught off guard. That's how I've invested, and that's how I've lived. Not with certainty, but with a system flexible enough to deal with uncertainty. And in this world where things are constantly changing, that's the rare advantage you can have. Chapter 4. The psychology of human errors in judgment. I used to think mistakes come from lack of information. Then I met enough people with plenty of information who still made bad decisions. I used to believe that logic was the compass. Until I saw the whole market being pulled by a story that wasn't true. And I began to understand, we don't lose because we're ignorant, but because our psychological structure has too many dead ends. Those dead ends don't appear as signs but as shortcuts, attractive, familiar, easy to follow. Until you realize you're in wrong place. That's why I've spent a quarter of my life studying psychology, behavior, not to manipulate the market but to protect myself from myself. I understand that in investing the biggest enemy is not out there but between my ears. Identify the biases, the cognitive distortions that the human brain systematically suffers from. For example, confirmation bias. When you believe something, you only look for information that confirms that belief. You ignore facts that contradict it, or even dismiss it because it makes you uncomfortable. I've seen it happen to even seasoned investors. They fall in love with a stock and then become blind to all the warning signs and experience the aversion regret effect. When you're so afraid of making a mistake that you don't dare to act, or worse, you hold on to a losing investment just to avoid the feeling of having to admit you were wrong. I've seen people lose half their assets just because they said, wait a minute, maybe it will come back again. Remember herd bias? That's when people do something because they see everyone else doing it. The crowd went into Bitcoin in 2017, in 1999, real estate in 2006. They all believed this time was different. I learned that when you hear that phrase, get up and walk away. Most of us are driven by loss aversion rather than gain aversion. That means losing $1 hurts twice as much as gaining $1 feels good. That leads to irrational behavior. Cutting profits early because you're afraid of losing, holding on to losses because you don't want to admit it. I've made that mistake and paid for it with lost opportunities. Anchoring bias is also a dangerous trap. You see stock ABC peaked at $100 and now it's at $60. You think it's cheap because you're anchored in your head by the old number, but the actual value of the business has changed. The anchor no longer holds, but you're still drawn to it without realizing it. No. I also see the impact of framing. The way information is presented affects how we evaluate the same investment. If you say a success rate, people get excited. If you say a 20% failure rate, they get scared when it's actually the same. This is something the media exploits to their advantage, and it's something I've had to train myself not to be led astray. Overconfidence bias is one of the biggest dangers in the world. People think they know more than they actually do. They think that a few successes are due to talent, not luck. I call it the illusion of control, and it causes many big players to evaporate after a single mistake. I've seen fund managers rise like fireworks and fall just as fast because they think they're exceptional, someone who can ride the cycle. I never do that. I always assume I could be wrong. And I build my entire investing system around one question: if I'm wrong, will I survive? The combination of psychological biases don't just distort individual judgment, they create collective bubbles. A bubble is when an individual mistake is replicated millions of times. Prices no longer reflect value but emotion. And then you're no longer investing. You're playing a group psychology game where the last person holding the hot coal gets burned. That's why I always start by examining myself. I write down the biases I'm susceptible to. I try to create an investment process that makes me as emotionally unaffected as possible. And I set up a system of cross-checking where important decisions are subjected to a series of paradoxical questions. If someone I hate recommends this deal, will I still like it? If the price drops 20% after I buy, will I be rational enough to keep it? The smarter people are, the more likely they are to fall into the trap of overconfidence. It's the people with the best degrees, the best grades, the sharpest minds who are the biggest losers in the market. Because they not only misjudge in the situation, they don't even believe they can be wrong. And so when they make a mistake once, they double it, when they make a mistake twice, they suffer losses, and when they make a mistake 3 times, they lose everything. Investing is not a mental sport, it's a soft martial art. It doesn't require you to attack well, but to dodge. The most dangerous punches don't come from the market, but from blindness guided by the ego. I learned to doubt my emotions. Whenever I feel too excited, I stop. Whenever I feel too scared, I write in a journal. I don't let myself make decisions in an unbalanced state of mind. Because I know mistakes don't come from lack of information, but from the wrong emotional state at the wrong time. Think about the dependence on short-term rewards. Something we inherited from our hunter-gatherer ancestors. Our brains release dopamine every time there is a profit, and we become addicted to that feeling. Like gamblers pulling the levers of slot machines. We don't invest to get rich, but to feel good. True. And so we easily rush into decisions I make just for the sake of validation. A young investor once told me he had just doubled his money in 3 months. I asked, "How did you prepare yourself to lose half of it in a week?" He laughed, "You can't lose it that fast." I didn't answer. A few months later, he came back broke, and the only question left was, "Why did that happen to me?" I told him, "Because he's human, and humans make mistakes." I don't tell this story to teach anyone a lesson. I tell it to remind myself every day that if I don't constantly reevaluate my thinking, I too can fall victim. I too can be swept away by the wave of euphoria, blinded by a string of consecutive gains. I don't believe in any system that doesn't allow for humility. Because pride is where the biggest failures begin. So I always leave a part of my system for the unpredictable. I don't try to predict, I guess, what the market will do. I only prepare for what I will do when the market does something I don't like. I always stay disciplined not because I am rigid but because I know. In a state of high emotion, I am no longer myself. I use checklists for every investment decision like a pilot checks the plane before takeoff. Not because I doubt my intuition but because I doubt the version of me when I am excited or under time pressure. Checklists help me keep the sober version, the version I trust the most. I also learn to take a step back. See the market as a game that I can choose not to play. I don't always have to buy, I don't always have to react. Sometimes the wisest decision is to stand still. People are afraid of missing out, I am afraid of rushing into things I don't understand. Mistakes are not the enemy. Hiding mistakes is if you dare to look directly at the reason why you are wrong, you can fix it. If you blame the market, the circumstances, if you don't check your thinking today, you'll make the same mistake again, just in a new form. The market is a machine that transfers money from the impatient to the patient. I believe it's also a machine that transfers money from the self-conscious to the self-conscious. If you don't master your psychology, you'll forever be a pawn on the emotional chessboard. No matter how much data you have, I don't claim to be immune to bias. I just build a system to identify it as early as possible. And I live with the assumption that if I don't check my thinking today, I'll probably be irrevocably wrong tomorrow. Because in investing, as in life, those who don't learn from their psychological mistakes are doomed to repeat them forever. Chapter 5. The right person for successful investing. The day I entered the stock market, I brought 3 things with me. A curious mind, a cautious heart, and a copy of Graham's book tucked in my pocket. I thought, like everyone else, if I could just understand the numbers, memorize the numbers, and follow the logic, I would succeed. But then I saw people who were better at calculating than me, more educated than me, collapse in crazy market seasons. They were everything but right. Investing is not just a subject of analysis, it is a lifelong psychological test. And the winner is not the one who calculates the best, but the one who survives the longest with the right value system. What I call terrastop. The first quality I call independent thinking, to the point of being eccentric. People who can step out of the crowd, not to do the opposite but to see with their own eyes. They do not need the market to confirm, do not need the approval of others. They are confident enough to say no when everyone says yes, and they do not find it strange that they only buy 3 stocks in a year. Others change their portfolios like changing clothes. I once met a person like that. He never looked at financial news, did not read technical analysis, just sat reading regular reports, the annual report and the shareholder letter. Year after year, he maintained his portfolio as if nothing mattered. And as a result, he was 10 times richer than those who ran blindly, because he didn't make money from speed, he made money from consistency. The second quality, iron discipline. Cold as a nuclear power plant operator, you can't let emotions get in the way of your decisions. Don't think you're invincible because you've made 3 gains. Don't panic sell because you've lost a week. Discipline isn't something you're born with. It's something you cultivate day by day, decision by decision, painlessly taking a seemingly good but unethical opportunity. The third quality, the ability to learn all the time without being poisoned by information. You need to constantly expand your knowledge, but you have to know how to discard the rubbish. I see many people read a lot. But their knowledge is like a tangled mess of wires that short out. People with turf know how to filter. They don't need to know everything. They just need to know the right things that can be applied. And leave the rest. The fourth quality, humility, to the point of assuming you're wrong. People say confidence is the key to success. I think humility is the door to survival. You should never believe you understand the market, never believe you're immune to bias. You should always ask, what if I'm wrong? And build your portfolio in such a way that you can survive being wrong. A man invested in only 1 stock because he knew it like the back of his hand. That year, that stock had a legal problem. His account evaporated 70% and he disappeared from the market. I don't need to say more. The lesson speaks for itself. The fifth quality, patience, to the point of being called lazy. The market is where the impatient pay the patient. I once didn't buy anything for 18 months. People asked him, "Don't you see opportunities?" I said, "I see a lot, but none of them are safe." And then when the crisis panic came, I bought more stocks in 3 months than the previous 3 years combined. At the low prices of the financial crisis, the tryst stop is not in the degree, not in the speed of reading and understanding reports, it is in the character of the person. You can teach a person how to value a business, but you cannot teach them the ability to wait. You can teach them the discounted cash flow model, but you cannot teach them the courage to stand still when the market screams in panic. I once tried working with a very smart young man. He was good at math, quick, reacted well to news, but he could not sit still. Every day he had to do something: buy, sell, analyze, search. I told him, investing is not a game of speed, it is a test of latency. He did not listen. 6 months later, his portfolio was like a storm without end and eventually a circle with no way out. There is a simple truth that few people have the patience to accept in investing. Most of the time you will do nothing all, you will wait. Wait for the opportunity, wait for the right price, wait for the market to go crazy and then wake up. The difficult thing is to wait without going crazy, wait without doubting yourself, wait without wondering if you are wasting your life. The most necessary quality of all, the one that makes true quality, is inner peace. That is when you can sit alone in silence, not being urged to do anything, not being manipulated by emotions, not being forced by expectations from others, you can maintain that calmness, then you can invest and live soberly. I was once between two choices. One is to pursue a deal that everyone claims will be a surefire hit. The profit on paper can be up to 200% in just 6 months. The other is to ignore it. Because I feel something is wrong. A small detail in the audit report, an unusual change in the executive board. I choose to stay out. 6 months later, that company is involved in a serious financial scandal, the stock price drops 90%. At that time, I didn't think I was good, I just thought I was lucky. But that luck came from being sober enough not to be swept away. Therapy is not the ability to always be right, but the ability not to lose too much when you're wrong and live long enough to be right. You can win the whole cycle. That's why I always build my portfolio on the principle of not dying from mistakes. Because I know I will be wrong. Everyone does. But people with a strong defense system still have a chance to recover when they're wrong. People without one. Just one big mistake is enough. You can call it the art of defense. I call it survival instinct. And in the investment world, survival is the foundation of everything that can be built on. Part of being right is saying no to easy temptation. I've seen deals that are full of temptation, with promises from friends, colleagues, even the media. I feel like everyone is forcing you into a behavior. If you don't go in, you're stupid. If you're late, you'll regret it. And if you're out, you'll be considered unfashionable. But I don't care. I don't live to be fashionable. I live to have no regrets. And the biggest regret in investing is not missing an opportunity, but knowing you're wrong and still stubbornly following through. People with a stop know that no opportunity is the last. The market always opens new doors, but you only have one key, which is your own discipline. Lose it, and you're left with nothing to defend yourself against. I've met many good people. They can read financial reports like they're reading short stories. They can remember every line of data, but they can't say no to a risky deal because they're afraid of being left behind. They don't lack information, they lack backbone. And stuff is backbone, the ability to not collapse in a raging market, the ability to stay disciplined even when it makes you temporarily look foolish, the ability to play the long game without losing the battle for a few small wins. Summary: I have been wrong many times, but I survived, and after each mistake I rewrote the reasons, dissected my emotions and looked back at my decision-making process. I did not blame, did not make excuses, did not say what I wished for, I just learned. Learn to make less mistakes next time and be more deeply right. Stop is something no one can give you. No teacher can teach you, no book can show you. You can only find it through each financial storm, through each sleepless night because of a wrong purchase order, through each time you sat looking at your portfolio in red and still kept calm in your heart. I cannot tell you how to always be right, but I can show you how not to die from being wrong. And that, in my opinion, is the most important thing an investor can learn, because in the end, it is not the smartest person who wins, but the one who does not give up, the one with principles, the one with the right quality. The quality that helps them go through cycle after cycle and still stand firm when others have disappeared from the table. Chapter 6. 7 Variables in the Value Investing System of Graham. Investing became a few simple formulas after a few years. I learned more about financial analysis, business valuation, portfolio management, all the things that were taught in books. But then after many more years, I took a long detour to come back to something simple. Every good investment decision revolves around a few basic variables, not many, just 7. But you have to understand them like you understand your own personality. Graham calls them the 7 variables, the 7 core variables of the value investing system. But to me, they are not lifeless variables like in equations. They are 7 heartbeats, 7 reaction patterns, 7 layers of defense before you put money into any business. The first variable, current earnings, is simple but surprisingly undervalued. People are fascinated by growth prospects, by expansion prospects, by distant promises. I ask, how much money is this company making right now? Not 5 later, not 10 years from now, but now. Where does that money come from? Is it sustainable? Really? I don't believe in science fiction models. I need to know a business can support itself and me in this reality. I have seen companies live by expectations. Not profits, they evaporate like smoke after a policy wind. And the investors who follow them often never come back. The second variable, future growth prospects. This is where psychology starts to come into play. Because humans are future-obsessed creatures. We are easily seduced by stories. If everything goes right, profits will increase 5-fold. I do not deny the importance of growth, but I always ask, where does this growth come from? Can it be repeated? Is there a competitive advantage that can sustain that growth? I divide growth into 2 types. One is real growth coming from product innovation, market expansion, and process optimization. The second is fictitious growth, inflated by marketing, asset revaluation, or leverage. Do you know which type is more attractive to investors? Of course it's virtual. Because it makes for a beautiful story. But you're not invested in the story. You invest in cash flow. The third variable, dividend yield. Young people often do not care about dividends. They like capital growth. They think, why get a few % per year when I can 10x my account? I understand that. I used to think so. Until I saw that discipline in paying dividends is the sign of a business that truly cares about its shareholders and has the strength to maintain it. Dividends show me the company has real profits and is willing to share. It also serves as a cushion during market downturns. I don't need to sell stocks to have cash flow. I sit there and get paid year after year. It's not romantic, but it's extremely sustainable. Fourth variable. Price to earnings ratio (PE). A small number but one of the most misunderstood. People think low PE stocks are cheap. But not necessarily. Low PE could be a sign that the market is warning of something. The business is in trouble, the model is outdated, and the leadership lacks transparency. I don't buy something just because it's cheap. I buy when it is cheap compared to its real value. Likewise, high PE is not always bad. If a company has a high growth rate, strong competitive advantage, and outstanding profitability, a high PE ratio is reasonable. But you have to check whether it is high because of quality or because of inflated expectations. I have seen PE 80 stocks turn negative PE after a bad quarter. The market does not forgive fragile dreams. The fifth variable, net worth. This is one of Graham's and my favorite variables. It helps you measure how much would be left for shareholders if the company were liquidated today, selling all its assets and paying off all its debt. Sometimes the market would value a company lower than its book value. If the company isn't losing money or going bankrupt, you might be looking at a rare opportunity. I once bought a company whose market value was lower than the cash it had in the bank. Yes, their cash alone is more than the stock price the market is trading at, the rest of the factory, equipment, people, brand are almost given away for free. Of course, the question is not whether it is cheap, but why is it so cheap? Sometimes the market is right when it punishes a business, but sometimes it is just panicking. I didn't buy it because it was cheap. I buy because I understand what I am buying. I understand so well that if the market closes for 3 years I still won't worry. The sixth variable, financial position and debt structure. This is the variable that is often overlooked until everything falls apart. I always check a business's debt level the way a doctor checks a patient's pulse before surgery. A company with growing revenue but high debt. No different from a young, healthy person on the outside but with a heart full of plaque inside. Just one headwind, interest rates rise. The credit crunch is the whole system collapse. I have seen beautiful businesses with high profits on paper, but one day when they cannot borrow new capital, they start selling assets, selling their brands, and even selling themselves. I never invest in a business where debt repayment depends on growth expectations. I want them to survive even if profits are zero for a few years. Only those who make it through the winter with enough food left are worth my company. And the seventh variable is also the most subtle. Quality of management. This is something that has no measurements, no charts, no quantitative indicators, but has the power to decide everything. I've passed up dozens of great businesses because I didn't trust the management, and I've stuck with mediocre companies because I trusted the people running them. Quality management is not only about ethics, it is about capacity, transparency, frankness in reporting, the ability to take responsibility when wrong, and consistency between words and actions. I read every letter to shareholders. I watch how they react in crisis. I looked up their work history at their old company. I don't need them to be perfect. I just need them to be someone I'm willing to give money to and sleep well at night. I know what I share is not appealing to the generation that likes to follow the model of AI pricing, automatic charts, investment robots. But those who have gone through a real financial cycle will understand. Ultimately, what keeps you alive and moving forward is not technology but mindset. And these variables, 7 seemingly simple things, are the skeleton of a strong mindset. I don't use those 7 variables as a scorecard. I use them as a filter. I don't need every variable to be absolute. But if there are 3 or 4 dominant variables and none of them are red flags, I start to pay attention. Then I dug into each layer like an archaeologist, without haste, without being led by emotion. Sometimes I turn down an opportunity because of a small line in a financial statement footnote. Sometimes I choose to hold more just because I see the CEO still gets paid in stock and not in cash. Those little details are not secondary to me. They are signals, and signals are worth more than promises. Value investing is not about coming up with a perfect valuation model. It's about understanding the business well enough to know what you're buying, why you're buying it, and what you'll do if things don't go right. Graham's 7 variables, if properly understood, will give you the tools to answer those 3 questions with confidence. And if you know how to use them, no need to rush, no need to be too smart. You will have more than one chance to get rich. You will have the opportunity to become rich without worry, without regret, and without compromising yourself. Chapter 7. The right elements in a business. Throughout my years in business, I have realized one important thing. You don't invest in stocks, you invest in businesses. The stock code flashing on the screen is just a cover. Inside are people, strategies, cultures, and complex systems that do not appear in financial reports. If you don't understand the business, you're betting, not investing. And understanding business means recognizing what makes the right quality. The ROF in its very internal structure. Not every company born is worth holding for long term. There are beautiful names, trendy products, impressive growth, but inside it is as empty as a balloon inflated with expectations. So what kind of business is truly of quality? First I look at the business model. It has to be simple, easy to understand, easy to predict. If it takes me 3 hours and 4 slides to understand how this company makes money, I stop. I don't need complexity to see wisdom. I need clarity to see the possibility of survival. Remember this. A business can be complex in operation, but its money-making model must be simple enough for a child to understand. Coca-Cola sells soft drinks, Costco sells goods at low profit margins to keep customers loyal. Apple creates a closed ecosystem to keep users as long as possible, as simple, as controllable, as trustworthy. Next, I look for sustainable competitive advantage, or moat. Not every profitable business has a dent. You have to make this distinction. Profit can come from a season, a trend, a policy. Resilience is the ability to maintain that profit over time, through competition, through crisis. One I can come from a brand like Apple, from low cost like One, from network scale like Visa, from user data like Google, from distribution like Amazon, or from control of resources like a mining monopoly. You have to look at what the fad is and ask yourself, if another company wanted to compete, how long would it take them? How much money and how many mistakes to catch up? The third and often most underrated element is corporate culture. Culture isn't on the boardroom walls, it's in how employees respond to risk, how leaders deal with failure, how a company treats customers when no one is watching. A company with a strong culture will see you through a crisis. A company with only a slogan will fail as soon as the cash flow goes astray. I have seen 2 companies in the same industry, same size, same market conditions. A company that weathered the 2008 crisis and came out stronger. The remaining company went bankrupt in less than 6 months. The difference is that the first company has a team ready to share the leadership burden of Cat Luong first. Not fire anyone. The second company fired a series of workers at a loss and lost the trust of customers. As a result, one side recovered and the other disappeared. I also look at free cash flow generation. Frex flow is not accounting profit, not revenue, not EPS, but the real cash flow remaining after the company has paid all operating costs and maintenance investments. If a business generates steady cash flow even during slow growth periods, it is a sign of a solid machine but insufficient cash flow. I also need to know what they do with that money. Do they pay dividends? Are there any stock buybacks? Are you reinvesting in productive projects? Or are they using it to blindly expand, inflate numbers, or chase fame? How a business uses money reflects the true worth of its leaders. I call it a low skill capital intelligence. And only a small fraction of businesses get that. Most, even the good ones, use capital as if it will never run out. They buy other companies, expand into unrelated fields, hire high-priced marketing teams to buy growth. Then when the cash flow stops, they panic, cut back, sell off and lose their original position. One of my favorite questions when researching a business is, if the CEO disappeared tomorrow, would the company still function well? Because if a company's system depends too much on one individual, no matter how good that person is, it is not a sustainable model. The right business is the one that can continue to print money without someone shouting orders every day. I'm not looking for a business with superheroes. I look for businesses that have efficient self-operating systems. It comes not only from technology or processes but also from a stable and transparent organizational culture, where every level clearly understands their mission, role, and core values. And I always check for consistency between words and actions. If the company says they care about long-term shareholders, I'll see if they dilute the stock. If they claim to be committed to the environment, I look at the ESG report, what they actually do. If they promise to invest in core technology, I look at hourly costs and the profitability of new products. One can say anything in a meeting, but financial numbers and cash flows will tell the real story. I used to follow a tech company that was highly hyped in the media. CEO speaks eloquently, attractive products, breakthrough strategies. But I noticed one small thing: every quarter the number of outstanding shares increases slightly, diluting silently. Marketing costs are growing faster than revenue, hours and D are flat. The board of directors sells shares regularly every quarter. 3 years later, the company did not go bankrupt, but shareholders lost more than 70% of their value. I'm not surprised. And then there are the opposite companies that no one talks about. They are not flashy, but they grow steadily, they do not borrow, they have stable dividends, they buy back shares when the price is low, and their leaders only speak when absolutely necessary. After 5 years, they become pillars of the industry. Anyone who has held their shares gets rich peacefully. A proper business is also a business that knows how to say no to hasty growth. I like companies that refuse to expand if they cannot guarantee efficiency. I respect companies that close underperforming branches instead of continuing to inject capital just to save face. Because the business that knows how to cut the dead end is the business that understands that the most important thing is to survive in the long run rather than looking the best in the short term. I once said, a good business is like a money printing machine, with a non-arrogant operator. But I will add one more thing: a great business is a money printing machine whose operators always put the long-term interests of shareholders first. They do not try to manipulate stock prices to get quarterly bonuses. They build to last a lifetime. And that's why I love business, family. Companies where the founders still hold large shares, still sit at the dinner table with their children and grandchildren, still see the stability of the company as a legacy, not a number. They don't need to prove anything to the street, they just need the company to not fail. And that makes them more motivated to protect real value than any outsourced CEO. Finally, I ask myself a question: if the market closed for 10 years, would I be willing to own this business? If the answer is yes, then it is a business with the right qualities. If I need hourly updated prices to feel secure, I'm not investing. I am speculating. The right in a business is not a score. It's the personality, the philosophy, the choices that a business makes when no one is watching. You won't see it in the IPO. You won't get a feel for it through a few lines of industry description. But if you listen closely, dig into the report, ask the right questions, you will see, and when you see, you should keep it. Because such businesses are rare, but when found, they will be the most valuable asset you will ever own. Here, we have not only closed a book, we have just gone through a system of thought, where investing is no longer dry math but becomes a way of looking at the world, a way of looking at oneself in life and death decisions about money. Reason and the limits of understanding. Charlie Munger does not teach us how to get rich quick. He teaches us how not to die in ignorance, highlighted by the keyword growth. He doesn't teach us formulas, he shows us the essence. And that nature, whether we agree with it or not, forces us to rethink the very financial lifestyle we are pursuing. If you feel challenged, forced to question old beliefs, or even a little insecure after reading this book, you're probably on the right track. For real knowledge does not put the reader to sleep, it inconveniences, it shakes, it reestablishes. I know you may have come to this book simply because you want to understand more about value investing. But if you leave with a deeper understanding of yourself, of how you make decisions, of the role of humility in a world full of misconceptions, you've probably gotten more than any PE ratio or valuation model could ever give you. I sincerely thank you for taking the time to listen to this entire book. In an age where patience is becoming a scarce commodity, seeing you through to the end is not something I take lightly. If you found this book helpful, please leave a review. Although it is short, it is not for me to be praised, but so that others, who are lost in the sea of information noise, can find a real source of light. A word from you can be an anchor for someone in a storm of thoughts. And if you have a book that has changed your perspective, that has kept you up at night because of the ideas in it, or simply a book you'd like to hear told in a more in-depth voice, let me know. Because there is no journey more worth taking than the journey together in search of knowledge. With a clear heart and a spirit ready to be challenged. Thank you again, and if possible live and invest as Mo did, with humble wisdom, uncompromising awareness, and the belief that the best things often do not come from fame.